I just want to begin with the story for you guys, which is 4 hikes next year, and what's underpinning it.
Sure. Yeah, of course. 3 reasons, really. One, the rising probability of tax reform, adds to the Fed's confidence, continuing with their gradual normalization. 2, I would say the FOMC becomes more hawkish next year, given the regional presidents who are rotating onto the committee. And 3, this is kind of sort of the key one for us, is that you've had the improvement in core PCE inflation. So the near-term trend, the 3-month annualized rate, was 1.9% in October. So it's just sort of the Fed's 2% target, and the Fed knows that once the wireless services component drops out of the 12-month year-over-year rate beginning in Q2, that inflation should be much closer to their target. So we add it all up. For us, it makes sense as long as the growth outlook looks fine. The labor market's below most estimates of full employment. Keep going.
Brett, you're above the consensus and you're above where the market is. Once again, the market and the Federal Reserve's got to reconcile its differences. But the market for a long, long time was the better predictor of where the Fed was going to be than the Fed themselves. Why is that going to change next year, Brett?
Well, I think the difference this time around is that the global growth outlook looks much better, at least at the moment. And we don't see many major issues either in China or Europe at this point. Europe's growing close to 2% now. Japan is even seeing positive growth, and the trends look okay there. So I think the global growth momentum is going to be the difference this time around, whereas in the past the Fed's sort of been held back by what's been going on in other countries. That could always change, but at the moment, we don't see too many issues on the global horizon.
Brett, as you sit down with a fixed income desk over at Deutsche Bank, what kind of call have they got on the yield curve? If we're pushing 2.5% on the policy rate of the Federal Reserve next year, where's the yield curve going to be? Yeah,
well, that's the thing. I mean, the estimates of where the end point is haven't really changed in close to 6 years. As I like to remind people, the 10-year rate was around 230 3 years ago, and it was around 230 6 years ago. So I think the general trend of curve flattening probably continues for a bit, and we'll see how the Fed reacts to that next year and whether that concerns them or not. But that's going to be a big question, of course.